A single swipe at 11:47 p.m. triggers a chain of events that costs you $35, but the bank's actual cost was less than $1. That gap between what you pay and what it actually costs the bank is where the real story of overdraft fees lies. It's not just a penalty. It's a carefully engineered revenue stream built into the architecture of modern banking. And understanding how it works reveals something deeper about how consumer finance operates when we're not looking. Overdraft fees emerged in the 1980s when checking accounts were still paper-based and banks bore real costs processing returned checks. Back then, the fee made sense. It covered labor, postage, and the administrative burden of a declined transaction. But digital banking changed everything. Today, that process is automated. It costs almost nothing. Yet fees have climbed higher, not lower. The average overdraft fee now sits between $30 and $35. Some banks charge multiple times per day. A person who overdraws by $2 at 8 a.m. and again at 2 p.m. might face $70 in fees before the day ends. The math is inverted. The penalty bears almost no relationship to the actual cost incurred. Here's where the structure becomes deliberate. Banks don't charge one overdraft fee per day, they charge one per transaction. They also control the order in which transactions post to your account. A bank can arrange large transactions before small ones, maximizing the number of overdrafts triggered. It's a sequencing game that directly inflates fee revenue. The impact falls hardest on people already struggling. Those living paycheck to paycheck are most likely to overdraft. One unexpected expense, a medical bill, a car repair, can trigger a cascade of fees that makes climbing out of the hole even harder. Overdraft fees disproportionately affect lower-income households, turning a temporary shortfall into a financial trap. Banks justify these fees as a service. They're extending credit, covering your purchase even though your account is empty. But that framing obscures what's actually happening. They're not offering a loan. They're charging an enormous percentage rate for a few dollars of short-term coverage, then repeating it multiple times. The system persists because its profitable overdraft fees generate billions annually for the banking industry. And because most people don't fully understand how the structure works, the fees remain invisible until you experience them. That invisibility is part of the design. Once you see it, though, the mechanics become clear. Understanding overdraft economics isn't about blame. It's about recognizing how a system functions and what incentives drive it. Banks operate within the rules they are allowed to set. The question is whether those rules serve consumers fairly or whether they are engineered to extract maximum revenue from those least able to afford it. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you're curious about the hidden mechanics that shape your finances, subscribe. We decode the systems that most people never see. This video is for educational and informational purposes only and is not financial advice. Always do your own research.